In market mania, the wild moves in the stock market and troubles among regional banks are making it challenging to know where to invest or where to save some money. We have Juli Niemann, the Executive Vice President of Smith Moore, here to sort it all out for us. Julie, what are some alternatives to the stock market for investing?
Well, first time in years, you have an alternative to the stock market. It used to be a TINA market. There is no alternative to the stock market. But now with the Fed conveniently raising interest rates so rapidly, there is a reasonable alternative, a Terra market. And that happens to be in treasuries, certificates of deposit, very short-term instruments right now. Bonds are becoming very, very attractive. Now, going long on a bond doesn't make sense at this point because interest rates are just too volatile. But investors and right now savers can really do a good job by putting that money to work in something laddering treasury bills and treasury bonds. That's where you're going to pick up the best yield. And here's another thought. You get your money back.
What kind of returns are we talking here?
Well, if you go out to a year and, just in that general area, you're going to get 4 to 5%, which is absolutely princely compared to what we've seen in the past. This time last year, you were getting a poke in the eye with a sharp stick, about 0.25%. But no longer. The Fed has been ratcheting rates up so rapidly, it's caused a lot of pain, obviously, in the financial markets, but the benefit has been to savers. And right now, investors, that's where you belong. It's time to get back into a balanced portfolio by getting those good, solid fixed income. And the best right now, truthfully, for a low-risk approach, are treasuries.
Tell us more about what you see for investors considering CDs.
Banks are really loath to raise CD rates if they don't have to. But so much money is coming out of the banks now and going into treasuries. Wealthy individuals, average individuals, everybody's rushing into treasuries because the yields are definitely higher. And of course, why not? That's exactly what you do. The banks, as of a day or two ago, finally started getting very competitive on their CD rates. In fact, some of the major banks are even offering CD rates at higher rates than the treasuries. Usually it's always at or close to the treasury. This time they're using them as loss leaders to get deposits in and nail down those deposits for a while. They need more deposits. And this is what they're doing, using this as a loss leader to get people in to buy those CDs. So there's a good opportunity right now. But again, take a look at which banks you have and really stay under the $250,000 limit. Layer them if you have to. But what you really need to do is make sure you stay within the FDIC limits of insurance. That's going to be repeatedly contested here, although it looks like once again, no matter what you call it, we're bailing out the banks.
Thank you so much, Julie.
You bet.
Go to businessfirstam.com for where to see our show on TV.